Warren Buffett is the second greatest investor to ever walk this earth, and he's often quoted as saying, "Be greedy when others are fearful." Fear has clearly taken hold as policy uncertainty, a cautious Fed, and geopolitical concerns come front to mind. But is right now the time to get greedy and to buy the dip? And if yes, what exactly should you be buying? Today, we're going to answer that question, as well as give you my top stocks to buy during a market pullback. I'll be giving you the names, a look inside my portfolio, and the full proprietary research notes from my firm explaining my picks in details. But the bigger question on everyone's mind isn't what do I buy, but when? When do I start buying this pullback? When do I start getting bullish? And when will the market turn? And that is the goal of today's video. I'm going to break down everything in granular fashion and make you a lot of money. So sit back, take notes, because we've got a lot to talk about. Let's roll the tape.
Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it.
This is the daily heat map of the S&P 500 and US stocks seesawed on Friday as Wall Street assessed the crucial monthly jobs report amid market uncertainty driven by President Trump's volatile trade policies. Now, stocks were mostly green today, except for some of these larger cap names. For example, look at the sector of retail trade. Costco was down 6% on the back of its earnings. As a result, Walmart was down 3%, Home Depot, Lowe's, and TJX also took it on the chin, and Amazon was down 0.72%. Here in financials, Berkshire Hathaway Morgan were down 0.4% and 1.73% respectively. Microsoft was down 0.9%, Meta was down 0.36%. Sort of these large cap growth names and tech names as well. But we also saw Eli Lilly down 4%, Tesla was down 0.30%, MasterCard was down 0.55%. And that was kind of it apart from a couple of names here in the financial space. Everything else was pretty green. We saw Apple, Nvidia, and AVGO really hold the large caps together. Google also performed. We saw Oracle was up 0.8%. Same with IBM, Palantir, Adobe, Johnson & Johnson, AbbVie. And then we saw these sectors right here, very, very green. It was just actually a broad-based rotation coming off oversold conditions. And that led the markets to have a pretty positive day in aggregate. Now guys, before we continue with the video, go ahead and become a channel member. Over the next weekend, I'm going to release a number of equity research reports and equity research notes, starting with the first one today, Evolution AB. This is a full research report, my fair value, what I think it's going to do, and we're going to update these retroactively. You can find them on the post tabs if you become a channel. Now back to business. Every single sector was green here today, except for the discretionary space and the financial space. These sectors fell 0.19% and 0.46%. Gold was also down 0.04%, but pretty much flat, and the S&P 500 up 0.5 percentage point. We saw defensive sectors like healthcare and staples green today, but underperforming the majority of sectors, underperforming the S&P 500. And the best performing sector was XLE Energy, and that was on the back of oil prices. We're going to talk about why oil prices spiked and how that benefited energy stocks. We also saw utilities up 1.94%. Again, somewhat of a play on the energy sector, and then technology was up 1.28% again on the back of AVGO, Broadcom, Nvidia, and Apple. Industrials also gained, same with communication services. Real estate was in default, and so too was the material sector. But it was a very, very volatile day. We were very green here in the early morning trade. Then we actually had a pullback. The majority of sectors were deep in the green. That had to do with some of the trade tensions. However, we paired a lot of those losses into the end of the day, and actually in aggregate had a pretty positive day in what has been a pretty volatile and red week so far. We only had one factor segment loose today, and that was large cap growth. They were down 0.72%, but every other factor segment actually gained today. In fact, growth was the worst performing segment, relatively speaking, but we saw value, core, and growth across all of these size segments perform very, very well. Mid-cap value and core large cap value and core outperformed their growth counterparts. And we just saw a green day in aggregate today. I mean, even in this large cap growth segment, stuff like Apple, Nvidia, Broadcom, they were pretty green, relatively speaking. Now, there was a lot of news that came out today, especially on the geopolitical front. Oil rallied on Friday after President Trump threatened more sanctions against Russia if a peace deal with Ukraine was not reached. He came out and tweeted, "Based on the facts that Russia is absolutely pounding Ukraine on the battlefield right now, I am strongly considering large-scale banking sanctions and tariffs on Russia until a ceasefire and final settlement agreement on peace is reached." So a lot of geopolitical uncertainty, but what Trump is doing is putting pressure on both sides to go ahead and get a peace agreement together. Trump also threatened new sanctions on Canada, including a 250% tax on dairy, as well as Canadian lumber. Now, these trade war worries are still keeping markets on edge. However, Trump did pause tariffs on most goods from Mexico and Canada. Canada responded with a matching delay in its second wave of retaliatory duties, while Mexico has yet to directly react. So that on the tariff front really did impact markets, and that's why we did see a little bit of volatility midday in the market. We also did get jobs data today, and it was actually significantly better than the market thought. We had Bloomberg consensus numbers floating around of a 66,000 non-farms print, and while we did miss the consensus of 160,000, reporting 151,000, and the unemployment rate did tick up, I think the sentiment going into this print was for a significantly worse print. There was only 10,000 government jobs lost in the month of February, a lot less than the market anticipated. And that is actually why we kind of rallied on the unemployment rate increasing, as well as non-farms missing expectations. Average hourly earnings month over month, year over year pretty much came in line at 0.3 month over month and 4%, missing the 4.1% expectation, but inconsequential really. And then the participation rate pretty much matched expectations. Jerome Powell came out and had a speech today. He told lawmakers on Tuesday that the Fed is in no rush to adjust the interest rate, reiterating a cautious stance as central bank policymakers digest signs of stubborn inflation and policy uncertainty from Trump's new administration. And I quote, "As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves," Powell said during a speech in New York. "With our policy stance now significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance." So not much has changed. The Fed are in wait and see mode, and they're reacting to all of the developments in the economy. Now, looking at some market movers, McDonald's was up nearly 4% today on the back of the company upgrading its technology at 43,000 locations with internet-connected kitchen equipment, drive-thrus, and management tools enabled by AI, according to a report from the Wall Street Journal. The market is also piling into McDonald's as softer economic data rolls in. Many believe this company will do well regardless of the economic situation. Based Walgreens was up 7% today as the drugstore giant is preparing to exit the public markets. The company has sealed its go private deal with Sycamore Partners worth up to $23 billion following months of negotiations with the PE firm. Walgreens entered into a definitive agreement to be acquired by an entity affiliated with Sycamore. The company said in a statement late on Tuesday, shareholders will receive a total of $11.45 per share in cash, or $10 billion at the close of the Sycamore transaction. The additional value in the deal comes from an extra $3 in future monetization of the company's debt and equity interest in Village AD. The CEO came out and said, "Throughout our history, Walgreens has played a critical role in the retail healthcare system. We are focused on making healthcare delivery more effective, convenient, and affordable as we navigate the challenges of a rapidly evolving pharmacy industry and an increasingly complex competitive retail landscape." There's not much premium to be extracted from these prices right here. And the truth of the matter, based on the stock's 95% decline from its highs, the best thing for the stock was to have a go private deal because the stock does not act well in the public markets. Looking at overall market breadth, there were 3,400 advances, 2,800 decliners. We saw outflows in the New York Stock Exchange, quite significant outflows. However, the S&P 500 was up 0.5 percentage point, and that was driven by inflows, mostly in the NASDAQ 100, to cap off what was a very volatile week. And looking at market momentum, we finally saw some light at the end of the tunnel. The 5-day moving average finally eclipsed the 50% mark. And this is how it begins. You start here with the shorter term moving averages, right? And then you move into the medium term moving averages and then the longer term moving averages. So this is very positive. You love to see this type of thing. Now let's keep this momentum up and go ahead and retake the 20, 50, 100, and 200 day moving averages. Let's hop on the chart. Now, looking at the charts, this is what the S&P 500 has done in the last week. The S&P 500 down 3.52%. So a pretty ugly week, literally making lower lows or lower highs, with a low being put here in on Friday and us barely eclipsing some of the key levels. So a lot of work. The bulls have a lot of work to put in next week if they want to see higher prices, and the bears clearly in the driver's seat despite the actual gain we saw today in the S&P 500. Let's go ahead and actually compare this to the rest of the market. We're going to add the Dow Jones, the IWM, the RSP, as well as the triple Qs onto the chart. And for the most part, all of the major gauges came under pressure. The SPY was kind of in the middle of the road. The best performing index was actually the RSP, but it still saw negative returns, down 2.48% for the week. And the worst performing was actually IWM high beta. That was actually down 4.6%. So a very, very ugly week across the board. And you can see we actually put in a low here on Friday, which means this is an absolutely key level for next week for all of these indices. This Friday low is literally going to determine if we move higher or lower into the week. And then looking at actually what we did today on Friday, the S&P 500 was up 0.5 percentage point, the NASDAQ 0.7%, the IWM was up 0.3%. We're seeing mixed price action in the after hours, and then mid caps and small caps was sort of in the middle of the fold. A bullish day, but coming off what was a pretty ugly week in aggregate. Today, value actually outperformed growth, no surprise there. And we saw the VIX pull back below the 23 area. We actually did see yields gain as a result, and that actually had to do with a lot of the tariff talk as well as the geopolitical concerns. The 2-year yield gained, a 10-year and 30-year yield, but the dollar did fall as well. So, and again, you could really go to show that normally when we get weaker than expected economic data, yields typically fall. They did not. So the market is telling you that, hey, we're probably more worried about the geopolitical stuff as well as the tariffs than we are the economic data, because the non-farms, while we did miss consensus estimates, the expectations coming into that was for a very, very ugly print. And that is why we actually saw yields rise as a result. Bonds fell. Bitcoin actually fell 3%. And if you guys go ahead to my second channel, FinFluential Media, we talk about why I think Bitcoin might actually rally towards the end of March. It all has to do with global money supply and liquidity. Now, gold was kind of flat here today, very close to the $3,000 mark. And there's just a couple of things I want to highlight before we look at the S&P 500. Now, the S&P 500 was incredibly volatile today. The put support did not move at all, even though we did have quite a lot of price discovery below. Today, we actually managed to close above yesterday's close. So very volatile price action. But this is what you expect in negative gamma. For those of you that don't know, when you're below the gamma flip zone, you're in negative gamma. And that means options dealers who hedge their books need to buy into strength, sell into weakness. And that is why you get this type of volatility right here. But the bulls really, really like this level. They came in a big way, and they didn't just take us back into negative gamma. They took us above yesterday's close, and we actually saw some price discovery at yesterday's open. Very, very interesting. However, we didn't get to yesterday's high, and that is a bit of a concern, which means that strength in the bullish momentum wasn't as strong as it could have been or as it should have been, relatively speaking. So for the bulls to actually see more upward momentum, we probably need to go ahead and take out Thursday's high. We do that, then we can go ahead and look at the 58.55. Otherwise, it probably means more volatility ahead, especially with trade uncertainty and everything in between. However, put support didn't move lower, and that is largely constructive, but we are still in negative gamma. And you can see we actually did go ahead and hit this level right here, the 57.30 level. So I said once we broke this negative gamma level, I said our downside target is that. We've hit our downside target, and we may have actually formed a bottom and gone up from there. If we actually measure it peak to trough or peak to close, we saw a 1.84% move in the S&P 500. That is pretty significant, but that is also coming off what was a pretty ugly week, all things considered. Like I said, the S&P 500 down in excess of 3% this week. The NASDAQ 100, very similar situation. We did break the put support ever so slightly. We did say that we were going to hit this downside target in yesterday's video. We didn't stay there very long. The bulls really liking this resistance zone in the NASDAQ 100 and now onward and upward. But again, we couldn't actually go ahead and retake the high of yesterday, but we did actually go ahead and have price discovery above yesterday's open. And that is largely constructive. And this is again the same low, and we close at the same area where we have seen quite a bit of buying. There's been quite a bit of buying here. You can see by the wick right here, yesterday, the candle and the wick we got. So there's certainly buyers coming in, bulls coming in and taking advantage of the NASDAQ 100 at these levels. Buyers are definitely there at the moment. And again, peak to trough, we go ahead, measure it, or peak to close, we're looking at a 2.37% move off the lows in the NASDAQ 100. That is pretty significant, but the bulls have a lot of work to put in before we can actually say this is anything definitive. But the put support didn't move, the gamma flip didn't move, and neither did the core resistance, meaning that the market is sanguine with market pricing as it is right now. Looking at the RTY, similar situation. Bulls coming in. We had a positive day. There's not really much to say here. I did say that this is a great place to buy, and really these charts are acting very, very well at the lows. It does look like we're putting in a bottom. But like I said in yesterday's video, it's very likely the low is probably going to come between, I would say, the 18th and 26th near the March OPEX. This could definitely be the low. I'm just saying that a definitive low will likely be put in after the March OPEX. That is the 21st of March. So that is the date we're aiming for right now, for a low to be put in and for us to make material highs and potentially new all-time highs in stuff like the S&P 500. The RSP looking really, really good. On a technical level, it's finding support at this very, very key level, and we continue to see that value rotation. We saw that today. Value outperformed growth, and value pretty much outperformed growth this entire week. We saw the RSP outperformed the S&P 500 as a whole, and that broad market rotation continues under the hood. So this is actually where you want to be a buyer of the RSP. And like I said yesterday, guys, you want to start dollar cost averaging. You want to start deploying capital at these levels. If we go lower, we'll buy at lower levels. But this is a great place to start deploying capital as we start to form a bottom, as we start to consolidate at these lower levels, and as we assess all of the policy and Fed uncertainty. Now, guys, looking at individual names, I do like, guys, I've been talking about this a lot. EVVTY Evolution. It's at this very, very key level, this $80 area. There's some very good news that came out. Evolution was actually up 1.76% today, outperforming all of the major gauges. Once we break this $80 level right here, I think it's onward and upward, and then we can see $84 and $90 very, very quickly. Now, a name I added to my portfolio. This is a utility company, APA Group. It trades on the ASX. It had great earnings. I just wanted a bit of defense in my portfolio. So this is a name you can look to add to defense. I do also like NRG Energy as well as Vistra Energy if you trade in the US. So guys, don't be afraid to add utilities to your portfolio, but some of these American utilities names can be a little bit overvalued. APA was actually materially undervalued if you ask me. In terms of hyperscalers, what name do I like right now? I really do like Nvidia. Again, I've said this so many times. If you apply a $5 earnings per share for this calendar year, and you apply a market multiple of 22, that's what the S&P 500 currently trades at. You're looking at a stock trading at the fair market multiple of $110 per share. Nvidia should not be trading at a market multiple. It should be trading at a premium considering its growth and moat. The stock right now is trading at $112 per share. So this is a great opportunity for you to go and buy and to retake all-time highs. If we actually go ahead, take a measured move here for Nvidia back to all-time highs, which I do think Nvidia will see sometime this year. That's a 35% very easy gain. I think you got a great margin of safety in one of the market leaders and beneficiaries of AI. So those are the three names that I'm really liking right now. Some defense and AI play, as well as evolution, which is on the verge of an absolute breakout right now. But guys, start deploying capital, start buying the dip. If you're a long-term investor, this market shouldn't scare you right now. In fact, you should probably start getting bullish, especially as sentiment capitulates and as we start to form bottoms and lows in many of the major gauges as the March OPEX approaches. So guys, stay safe out there, buy the dip, start deploying capital, and let's talk about sentiment and seasonality.
And looking at sentiment, this is the AA sentiment survey, a very interesting turn of events. So we still see very elevated bearish sentiment here at 57.1%, but we actually did see bearish sentiment tick down from last week ever so slightly. We also saw bullish sentiment tick down ever so slightly. So pretty much what we saw was just a whole heap of people just move into the neutral camp from both the bearish as well as the bullish side. That's very interesting. So we definitely hit peak bearish sentiment here last week, especially with the bulls at 19.3%. This is the type of stuff you will see at market lows, and especially if you're a shorter term or medium term trader looking to play upside, these are the type of numbers you actually want to see if you want to get long. Nonetheless, we are still seeing elevated bearish sentiment, and that is a concern. However, regardless of the ebbs and flows in the market, if sentiment turns, what we're seeing, you always want to stay invested, because the rule of the 10 best days highlights the risks of market timing. If you actually just remove the 10 best days from the S&P 500, going back to 2000 and 2015, the extremely positive returns actually turn into significant losses. So you always want to stay invested, and in fact, even double down when things look incredibly bearish, because when they look the most bearish, that's often when we turn. And if we look at seasonality from Trump's previous tariffs in 2017, 2018 to Trump's tariffs right now, the 2.0 version, it's around about this time here in March when we actually saw a bottom and we had a bit of a rally. Now, this point right here is towards the end of March. It likely coincides with that March OPEX. So we can actually expect a little bit of downside into this March OPEX. However, not much more downside than what we've already seen. And then if history is any guide, we should see a little bit of a rally, potentially even taking out those highs. However, this is not a crystal ball, guys. Seasonality is not a crystal ball. It just allows us to assess probabilities for what might come. Now, this might not materialize and we could just continue the dump. However, if history is anything to go by, we could actually see a bit of a turn here in the equity markets. Now, what could also support the rally is actually the dollar. The dollar has been acting very, very constructively and in line with what we saw in Trump's last term. This was the dollar after the last Trump election. It made a steady move down after his election day. Inauguration was around about here, and we're seeing very much the same movement in the dollar. We see dollar making lower lows, lower highs, and do expect much of the same. And we could actually see a low of 94 here in the DXY. We're currently trading at about the 102, 103, 104 area in the dollar. Now, guys, we also don't want to lose sight of the fact that earnings are looking very, very good. This is outdated for Q4, that this number is closer to 17%, but regardless of that, Q4 earnings were very, very strong, led by the sectors you want to lead: financials, comm services, and technology. We smashed estimates coming into this earnings season. We beat on revenue, beat on margins, beat on earnings. And at the end of the day, S&P 500 will always follow the path of earnings. And if these types of earnings continue throughout 2024, this pullback sets up the S&P 500 for a great opportunity to go higher. Another supportive factor in the market right now could actually be liquidity conditions. Liquidity conditions are in very bearish territory. Generally speaking, when we get here, we actually normally see quite a bit of reprieve, not just in the US, but in the Euro markets as well globally. So liquidity conditions could definitely be on the side of the bulls. And if all of this sets up at the same time around about OPEX, we could definitely see the market move higher post-March OPEX. Also, don't forget that the OPEX in March is the big quarterly OPEX, the first quarterly OPEX for the year. Now, looking at the macro, guys, something that's held this market together for most of 2024 and 2023 has been the resilient economy and consumer. However, that came to a halt this week when Atlanta Fed's GDP now printed a negative 1.8 and then negative 2.8% figure, and now sitting at around the negative 2.3% range. Now, this is a little bit of concern. It has to do with the imports, exports, and the trade balance. Now, the blue chip consensus still pegged their GDP figures around the 2 to 3% range. So we'll see who's correct. My best guess, the truth is somewhere in the middle, around the 0% level for GDP growth here in the first quarter. Now, something that is very odd, despite what we saw with GDP, federal employment tax receipts still looking very, very strong here in the month of March. So this is March so far. up 6.8%. We'll see how the month evolves and we'll see how the year evolves, because even though federal employment tax receipts look strong, initial jobless claims in Washington, D.C. with all of the federal layoffs have spiked in a very big way. Now, these employees do have very long severance packages, but once those severance packages come full circle, we'll see if the private sector will be able to absorb all of that labor. If Trump's policies do what they say they do, the private sector might, but there will be a little bit of short-term pain that could lead into 2026. Looking at earnings next week, so we have nothing major on Monday. On Tuesday, we do have jobs. That's the big data point on Tuesday. The forecast there is for 7.5 million. And on Wednesday, we get these CPI figures, both the core and the headline. We're looking for a headline year-over-year rate of 2.9%. The previous number was 3%. So that's very interesting. We should see a deceleration there in inflation overall. Then on Thursday, we also get the PPI figures, the headline figure and the core figure. We're looking for 0.2 and 0.3 in those respectively. We also get initial jobless claims and then Michigan consumer sentiment. And then looking at earnings next week, we also have a pretty big week. We have Oracle and Adobe, the two big heavy hitters. We also have PDD, as well as Crown Castle, Ferguson Enterprises, Lennar, that's a home builder, they're reporting earnings. A couple of other big names, Williams-Sonoma, Viking Holdings, Dick's Sporting Goods, Dollar General, Ulta Beauty, DocuSign, Casey's, Neo is reporting, and then Service Titan. That company actually just IPO'd a couple of quarters ago. That'd be very interesting to see their earnings. Path, Sentinel One, Vail Resorts. So not a huge week of earnings, but definitely some individual China names, software names, infrastructure names reporting that could definitely move the market. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Cheers.